Welcome to Digital Currents, brought to you by Morgan Creek Digital. I'm Xavier Segura. Each episode, we spotlight the topics and people changing the tech industry with a focus on AI, blockchain, chips, and big data. Thanks for listening, and please make sure to subscribe if you like what you hear. And remember, stay current.
Happy Friday, all. Happy weekend. I am going solo today. Welcome to Digital Currents. My friend and partner, Mark, is taking some much needed PTO with the family, and we wish Mark well. And Mark, if you're listening, we're looking forward to joining back with you next week. So enjoy the time away. We know that a lot of our listeners will be tuning in for their breakfast. So if you have not turned off by now, I thank you for staying tuned, and hopefully we can touch on basically what we do every week on Digital Currents. We touch on the latest and greatest around really the ways we think about our investment strategy here at Morgan Creek Digital. That's in and around the ABCDs, artificial intelligence, blockchain, chips, and data. And of course, we have to weave in a little bit of the macro so we know just what the actual backdrop is for all of the investment strategies. And I think now we're into the summer doldrums, right? Where folks are on vacation, but they're kind of keeping an eye towards email, mostly personal, but the world keeps moving, right? In particular, the 24/7 digital world that we are a part of is one that does not stop. So I would encourage folks to check out the webinar. We'll see if we can make that recording available, where we did a deep dive on the latest and greatest with the, as Mark says, the Lack of Clarity Act. And so this was really important because there was this goal which we were trying to see if regulators could abide by, figuring out if something could pass before the recess. Spoiler alert, lawmakers did not vote on the Clarity Act the week before the August recess. So kind of what this does is it pushes back some of the expectation that anything substantial as it relates to clarity may be decided upon in a short amount of time, meaning, before I'd say 27 at the earliest. What you're going to go into now is full-on campaigning season, and it's been super, probably unsurprising that there have been sort of one group of lawmakers that have been pushing forth with a strong pro-crypto agenda, and a second group of lawmakers that have been much more anti-crypto legislation. And it's very interesting kind of when we say both, and we had really good participation on this webinar when we're talking about clarity, which is really designed to provide a couple of things. It was designed to provide a framework for exactly this type of overseeing body would sit, the CFTC, the SEC, or, which three-letter agency would be involved. And then also it would kind of design other, levels of confidence within the broader market, with the kind of the broader backdrop of, is the US going to be a safe haven for crypto, or is it really going to push others, overseas in Europe or elsewhere, as has already been happening. So with that lack of a vote, it kind of now shifts things back to, okay, where do we go from here? So the SEC has now unveiled new guidelines, and reportedly they will issue a pair of rules to fill this regulatory vacuum that remains after we didn't get that vote on clarity. And so we've heard this story before, and really what this may mean in this case is that they could include an innovation exemption that would allow FIs to offer 24/7 trading of tokenized securities, and 4-year registration exemption for crypto startups. So when I hear stuff like that, those are signals that we pay attention to as venture investors that could potentially create an easier path towards launching companies. And again, within that backdrop, that macro uh, idea of making the US a safe haven to build companies and be more crypto friendly. Now, it's important that they are properly regulated businesses, but nonetheless, there needs to be some sort of an incentive to keep them here and to avoid the draw of places like Dubai or Singapore or other places in Latin America, for example, that have certainly been a lot more open towards this type of development. And additionally, what we're looking potentially from the SEC is that the guidelines could reportedly loosen fundraising reporting requirements and create a framework for some investment contracts for digital assets. And that's a bit of a mouthful, so I'm curious to see how they unpack that. Because it could mean a lot. It could mean the rise of ICOs again. We saw that there really was a bit of a softening period, certainly after we saw the rise of some of the IPO launches last year, Circle and others on the M&A side or on the SPAC side that created some new wave of enthusiasm. But then when we see the ICO kind of boom and bust cycles, they're really tied towards what happens on the digital finance DeFi side, where ultimately, if Bitcoin is doing well, it can also signal that some of the other layer ones can also do well. When BTC is down, generally it brings down the rest of the market along with it. So correspondingly, you're not seeing that same sort of performance boost with the ICOs. So when I'm hearing that the SEC is potentially looking to create some guidelines when it comes to these investment contracts or fundraising reporting requirements, that might either help or hurt this ICO issue. On the one hand, you can protect investors, which is supposedly SEC's job, by just creating a little bit more of that transparency and making sure everything is in lockstep. But on the other hand, it might just create additional worries for companies that are looking to fundraise via ICOs, and it could just push already a stress market to just wait on the sidelines. And so in general, I guess if you were to pin what the strategy is for this particular set of objectives that the SEC is looking to do, it's meant to pave the way for TradFi institutions to further push into the tokenization area. And I think that, in a nutshell, was a important piece of what Mark and I were discussing on last week's webinar, where the RWAs were not so surprisingly left completely absent of the Clarity Act. And when we're seeing just that rise of activity in the real world asset space, that's going to require a lot more conscientious thinking and a lot more deliberate action to make sure that the right set of policies and also the right kind of incentives are going to be matched up with more and more institutions like BlackRock, like Cantor, and others that are recognizing that this could create a new liquidity source to basically move traditional finance assets, bringing them in on chain, and just create hopefully a lot more economic activity. We've already been seeing that rise pretty much exponentially for the last 2 years. You've seen it across a couple of different asset classes like precious metals and of course some elements of real estate. And so another thing that we look at as a market signal for what's going on with Bitcoin and with other cryptocurrencies is what's happening with strategy, right? Mr. Saylor, anytime that there is a sell or a buy of Bitcoin from Saylor, it creates a whole lot of market news. Although I'm feeling that lately it has tipped the market way less than it used to. So he did sell a little bit fairly recently, but just on the heels of that, there has been some declarations that their intention is to begin buying Bitcoin again. this year. And this is pretty important to just reaffirm to some of the investors that their other strategy of both buying and selling could create just some market turbulence. So that could hopefully settle some anxiety. But basically, it helps also buoy and bolster their U.S. dollar reserve, as they didn't have enough liquidity to service this 12% bi-monthly dividend for the STRC part of the business. So it's basically the company's preferred stock. But let's not forget, basically, the whole big picture here is that Strategy still owns a lot of BTC. 840,000 coins at an average price of 75K. So they're, on average, a little underwater. But if you believe in the 4-year cycle, every 4 years, the top is higher than the previous top and the bottom is higher than the previous bottom. We will either experience that if you believe in history repeating itself, or we've broken that pattern and we'll kind of establish a little bit less vol, which might be the end game expectation as BTC continues to be more and more commonly used in just everyday life. And does that not have to mean we're using BTC to purchase a cup of coffee at Starbucks, which is the kind of tried and true example? It could just mean we use BTC as a method to store our wealth in addition to or instead of traditional gold. That's a huge market signal on where we are in that particular part of the S curve or the adoption curve. And then as we saw, another kind of indicator when we're thinking about, okay, what is going to happen with the overall Bitcoin market is just in general, how is the economy doing, right? And in particular, there's so many different economic signals that can come out at any given point in time. So we'll just pick one that was recently discussed on Wednesday, and that was the CPI. So the CPI rose 3.4% year over year. So we did see a little bit of a reported ease on inflation. But of course, Mark will immediately throw a flag on the field. So Mark, even though you're not here, I will make sure to pick up that flag symbolically and say that when we are looking at the CPI data, it is inherently flawed, right? Because why? It excludes some of the most volatile and important indicators of where the economy is at any point in time. It's excluding food prices, which are extremely volatile. Anybody who's gone to a grocery store will know this firsthand. And of course, energy prices. Anybody who has filled up their tank week to week can feel that pinch. I'm here in the comfortable state of New Jersey where we don't have to pump our own gas. So you have kind of like 1 degree of separation, I think, from what the price is at the pump to what you're actually paying because somebody is actually putting it into your car. But in general, we have a little bit of an ease on some of the tax impact on the gas. So it's certainly a little bit, quote unquote, discounted relative to our neighbor state, like New Jersey, or to a lesser extent, Pennsylvania. So when we're seeing what the impact of something like the CPI was to Bitcoin, we saw a bit of a drop below 64K on Wednesday. So we're seeing again a little bit of a movement, but not a ton in terms of how any one particular marker will favor or not favor the actual market. As time of recording, we're sitting kind of at a similar level now at 62.5. And what does this mean for things moving forward? I think when you're thinking about just taking a giant step back, looking at this from a year over year perspective, we're seeing from last year there was a jump of 2.5% for the same period last year. So what we're really starting to look at when you're thinking about inflation and pricing is what are the chances of of rate hikes later this year. And that's where we found historically have been some of the greatest impacts on Bitcoin prices in any particular period, in any particular economic session or data report. Obviously, international conflicts create a huge shock to Bitcoin at any point in time, and obviously have created also a little bit of a shelter for the asset class since the conflict broke out. We haven't seen it collapse like some of the others, or be nearly as volatile as some of the other investment categories and classes. So, when we're looking at the impact of CPI data and how it compared to last year and what's going on right now, this could potentially reduce the chances of a rate hike later this year. And so that is kind of what you will see as a market reaction for Bitcoin if investors and hodlers think that there's not going to be that hike, and what that correspondingly will mean to future Bitcoin prices. So a little bit, I guess, of a pivot, and we kind of think about what's been happening in broader parts of the market. An interesting idea from Tether before we kind of go completely off of blockchain. So they announced Thursday that KPMG has created a full financial audit of their financial statements in 2025. And I think this is kind of one of those stories where if you didn't know how to look at this precisely, it might slip under the radar. It might feel a little bit almost not that interesting or important. But I think that it is interesting for a couple of reasons that we'll go to. So let's jump right to the end. What did KPMG find? Because what happens with Tether, as we know, is it's one of the largest, or the largest stable coin in the world. And we just spoke at the jump about clarity and the lack of clarity that we saw before Congress broke out in session. So the idea is that stable coins have been increased in their usage year to year, and they will continue to do so as folks look for them as an easier, cheaper form of transacting intra-border and cross-border, right? So that's kind of like, in a nutshell, why they're important. Tether is the biggest one. And so when they had a financial audit completed by KPMG, this was an interesting move, as we know, because it creates some third-party validation about, does Tether really have the assets to back up, everything that it is issuing on stable coins, that is kind of backing the trillions that are getting spent each year through stablecoins. And they ended up issuing an unqualified opinion, which I thought was pretty interesting. What does that mean? The firm found the statements fairly presented, and the company's position results in cash flows under GAAP, which is pretty interesting. So Tether, their reserves exceeded liabilities by $6 billion, 6.8 billion to be more precise, at year end. And according to CoinDesk, they haven't heard back on whether the underlying KPMG findings will be published, but of course they made sure to release the unqualified opinion. And so, this audit, what does it really mean? It marks the escalation from the quarterly attestations that Tether issued since settling with the New York AG's office. And so what this means is that it verifies a very specific point in time where an audit tests transactions, valuations, and ownership records. I've gone through several on the investment side, and they can be and are designed to be, very detailed and very specific in nature. And so, it's really interesting is that auditors even physically inspected and counted the company's gold bars, right? So we're literally counting the gold bars of the, digital dollar denominated stable coins, right? And so it was pretty interesting because this came after like years and years of Tether kind of promising, actually, most recently back in March, that they had retained a big four firm for the job, having that external seal of approval after years of promising this. This is, I'd say, if you're a doubter that Tether is a house full of cards, you'll probably continue to be a doubter. If you're a full-on believer, you're going to come across beating your chest louder than ever before. And if you're somewhere in the middle, I think that you probably might be swayed a little bit more positively with some of this. Now their market cap, we know it's a relatively meaningless stat, but sometimes it can be useful in just comparing, one set of assets to another just for relative size. They're at over 180 billion, and it's become, like it or not, a significant buyer of U.S. government debt. So this is pretty significant, I think, both for the macro and for also our industry. And we'll see if they will release the broader audit report. I personally doubt it, but we will see if there's more to come. I guess now we can kind of pivot a little bit and talk about like what's happening in the broader market, how it affects some of the things that we do. We've had a pretty aggressive session when it comes to the other markets. We've experienced is that the rich keep getting richer. Those that are involved with an AI are being rewarded handsomely. What about some folks that are already public? Well, CoreWeave just rallied 19% on beating its earnings, and that was back on Wednesday. So that was at 108 per share after they posted a loss per share of 114 and 2.5 billion in revenue in Q2. So they did relatively better, up 112% from the 1.2 billion in revenue posted the same period last year. And so what was their explanation for this? It was kind of the tie that binds everything together, was that they had a revenue backlog of 104 billion as of June 30th, and another 25 billion in committed capital. And the key tagline, I think, that kind of ties a lot of folks that are in the AI space with climbing valuations is that they have more and more committed capital as hyperscalers continue to value for more AI computing capacity. And that's really what it's all about, is hyperscalers moving in, the need for greater and greater amounts of compute. And as CoreWeave is an integral part of some of this ecosystem, or then you have apps underneath that are kind of creating the outputs of this with folks like Cognition, you can see just a different impact, but directionally positive across the stack. Databricks, a little bit more of that kind of fundamental layer, still doing quite well. But what does this point to? It points to a potential day of reckoning in just a couple of weeks, right? We have been told that this fall, a lot of companies in the AI space, Anthropic, OpenAI, could be going public. And those will be the big whales that everybody is watching. In particular, what happens also downstream with hyperscalers. We've been speaking a lot about Microsoft's record performance. At time of recording, they are experiencing extremely strong performance, almost at $500 a share, following what was the single greatest day of market cap increase by any U.S. company. And this was, largely because of their positive results within AI, and as a kind of a core infrastructure investor and user of the technology, despite what you may or may not think about their office software and how good some of their office tools are. I myself have started to come around to Copilot. Just anecdotally speaking, I know Mark can't stand it, but I find that it helps kind of organize some of the thoughts a little bit quicker. Kind of can filter through some emails a touch bit faster, and I think that's also a little bit of like that pull versus push strategy, which is maybe why some folks are a little bit wary. Could Microsoft be a little bit overbought by this point? What you tend to see in AI, or just taking a huge step back in technology, generally when things are getting pushed to us, we have to be skeptical about what their staying power is or their ability to attract new users at a efficient rate. And so the challenge with big companies like Microsoft and Meta went the other way. It took a huge tumbling after not doing as well on its AI execution. But generally, when you have a huge push of technology, there is a little bit of a backlash on the consumer front. A lot of the technologies where people are maybe finding it a little bit more organically, those tend to be the ones that rally super fast. Think about the early days of OpenAI, first company, fastest company to 100 million users. Anthropic, now with its reportedly strong economic performance by this point, as they near towards public listing, there are reports that they are profitable at this point. That remains to be seen, and I think that will also be a benefit of if these companies do make it all the way public. This will be transparent, right? And we'll be able to see for ourselves and have an idea of what the directionality of the market truly will be, because so much of the alpha that we have seen in S&P or you name the listing is driven by AI companies, right? And so this kind of dovetails into the next story here is that Nvidia has signed memorandums of understanding, MOUs, with 6 major financial institutions, right? So the who's who: Apollo, BlackRock, Blackstone, Brookfield, Goldman, and KKR to build an independent compute financing platform, which is trying to mobilize more than $500 billion in third-party capital for AI infrastructure over time. And I think this is another idea where you're going to strike while the iron's hot. Nvidia is the 800-pound gorilla in the room. It's the straw that stirs the drink, whatever other analogy you want to use. Basically, Nvidia is at the center of this AI escalation and investment in infrastructure. Pretty crazy to think this was a company that was focusing on gaming in a relatively niche part of the market, and now is the entire market, right? Working with the largest FIs and most influential FIs in the world. And so their idea is to create a dedicated and large scale capital pools that will offer favorable rates to their customers, which could mean the frontier labs, enterprise applications, and of course the AI cloud providers, when we're talking about folks like CoreWeave, which had the big day this week. So this, according to Jensen, is a shift in kind of how Nvidia sells not just chips, but AI, quote unquote, factories, trying to create this new investable class. He's arguing that it's durable because hardware is fungible across customers and workloads, but the economics keep improving through their own proprietary CUDA software update. So they act a lot like Microsoft here, but imagine though if Microsoft was in concert with the 6 most major financial institutions in the world and controlled the product that everybody had to use that was funneling their growth. This feels like a case of absolute power. And we all know what happens with absolute power. It corrupts absolutely. That is a little dose, even though Mark is not here, of Sinister Saturdays. We would not go without an entire episode of Digital Currents without at least teasing out the ability to, or the possibility of there potentially being something asunder with somebody in the market, in particular the market itself. So what do the partners think about this? Apollo in particular, they tie this broader industrial bailout, and they tried to connect their kind of long-term capital with essential infrastructure. That kind of creates a more of a corporate speak to kind of justify they don't want to miss this party either. Goldman, to their own credit, they're backed by Nvidia Compute, so they're eating their own cooking. And of course, KKR is converting demand into delivered capacity through its digital infrastructure experience. So I guess these guys are just trying to attest that, hey, we're not just investors in the product, we're users of the product. And so, this is still pending. It's still contingent on final agreements being executed. And I will guarantee, we will guarantee, to quote Charles Barkley, for those NBA live on NBA fans or inside in the NBA fans, I guarantee that if we have a soft IPO launch this fall, that this agreement will not be executed, at least not anytime soon, or not without heavy, heavy redactions and revisions. So a little bit beyond where we sit with compute, we can go a little bit into what's going on with a couple other companies. I highlighted some of the big markups that we have been seeing lately in the AI space with Databricks Cognition, etc. Let's dive in a little bit more into Databricks in particular. So they've got this strategy of being oversubscribed by design, and so they had once planned a modest raise of 1 billion, but there was an about face that was done by their CEO, and investors called immediately, and basically forced his hand to roughly 15 times that amount, in just firms that were considering the investment. So rather than kind of turn away these long-term backers, they expanded the round. So they went from 15 billion and 190 billion in total valuation. So who was involved? Some of the usual suspects. Coatue was a lead, Blackstone, MGX, T. Rowe Price, and a couple others round out the slate. And so, the idea here is that there are strong fundamentals with 7 billion in annualized run rate, or ARR, which we say is a very deceptive stat, because some companies will even manipulate this to be not just monthly but weekly or even daily, to kind of spoof up their numbers, because things are moving so fast, and in particular growing so fast, that it's not sufficient to just say, hey, this is what I made last year. It may not be necessarily the most up-to-date of a financial performance of a company. So they'll say, here's my ARR, and I've broken this out by what my last trailing 30 days were, and I'm just projecting it forward for the rest of the year. And so this is what the number represents. And so in an investor's mind, the ARR makes the financial performance potentially better than just what the actual realized revenue may be, which is probably way smaller. It can also cut both ways, and I think that's the danger, right? Because if a company fails to continue on that same growth pattern, where they could just have a very strong month followed by a couple of clunkers, well, then that ARR number changes quite a bit, as does further their realized revenue, which you really want to figure out, okay, how is a particular financial metric, how does that impact the overall financial picture of this investment, its multiples, its peer set, and my ability to kind of come in on the right side of this. But again, market's moving so fast, companies in the AI space are raising faster and larger than ever before. There is a lot of FUD that's happening in the market, as we've been seeing. And then there's also just a bit of FOMO that happens. Well, if you're not going to take your share, then we'll find others that are willing to do so, because the idea is that compute needs will continue going up and up. I often use the example a lot of, when is the last time you deleted any pictures from your phone? You'll be with your family or you'll be with your friends, and you say, everybody gather closely, let's all take a picture. And my wife and family, we're all guilty of this, right? We have an anniversary special, and shout out to my mother-in-law and father-in-law for their 39th anniversary. And I was the designated photographer, and I didn't just take one photo in a particular location. I took 5. So I took 5 this way, for those that are on video, just straight on, 5 when everybody was standing, 5 when everybody was kind of circled and hugging one another, and ended up sharing just like one of each particular group of photos. Did I delete the others? No, absolutely not, because what if I want them? Or what is the real need of deleting them when I have so much storage, pretty much unlimited storage? And if I run out of storage, I can get even more storage. So that's the kind of basic idea that, well, companies are going to continue to expand. There's not going to be this kind of rate limiting factor, because we already spoke on a different show about how now, flash memory is potentially going to be solving some of the memory bottleneck issues that we were seeing with XK Hynix, and some of the other companies that had some real challenges and driving up the costs of our devices, right? Because of this memory shortage. Well, they were able to, or at least are experimenting with innovating their way around this. So looks like, at least for now, the financial picture is going well. Growing at 80%, per year, which is pretty crazy. Positive cash flow. They've got a cloud data warehouse business, which is 1.5 billion and doubling year over year. So that's looking quite positive. So what does that mean for an actual exiting out of the casino? To quote Ocean's 11, one of my favorite movies. They've told the CEO, Databricks, told CNBC that an IPO still remains is the eventual plan, though with roughly 20 billion raised in 20 months. And really, that money coming according to his terms, there's no immediate pressure or hurry, because as we've noted for years, companies are staying private longer and longer. But I do see that AI is a bit of an exception here. When we've kind of looked at, just even if we think about the ABCDs, we'll take blockchain companies. Blockchain companies historically have followed something like the average investor, boom or bust, a whole period, kind of that 6 or 7 years from kind of initial raise towards exit. Obviously, there's exceptions to every rule, but in terms of some of the winners we have seen, that tends to be what we have experienced, and also in the opposite, not so positive, but way more common outcome is when the companies don't perform. You'll know, kind of within that six-year window. Number one, they'll struggle to hit their financial benchmarks. They'll struggle to hit their capital raising requirements, and they'll struggle to hold on to the market lead of some of their products. And obviously, following the departures of key personnel that jump ship, that's a really big signal in just kind of tracking where the next either positive thing for a company or negative thing will be. Can they weather the storm, or will they succumb and sink? So when it comes to AI companies, we have been seeing exits more like 3 and 4 years for some of the more successful ones. Chip companies still take a long time, right? Because you have to physically make a product, and that requires a tape out, not just one time, not just 2 times, sometimes 3 times to actually get something right. The trick there is being able to convince your investors or figure out lean manufacturing techniques that will allow your cash to survive, because depending upon the scale of your operation, tape outs are very expensive. And they're also sometimes difficult to secure chip demand from fab producers like TSMC or Samsung. Especially in this AI arms race, allocation can be very tight. So when you kind of account for all of those, it's probably the slowest out of the A, B, and C's. Kind of the big data companies are a wrapper, tend to be a little bit more software based in nature. But AI has been a little bit faster. So the idea here that Databricks can call their shot is true to an extent, but they're not stupid, right? So they recognize that things still operate on momentum. And if, you're seeing huge multiples from some of their peers, they will probably look to execute on that bet. That reminds us, we have not really maligned SpaceX this week. So how have they been doing? Speaking of momentum and not wanting to miss out. So this is kind of one of the opposite. It was not a company that kind of exited in that conventional 6-7 year window. It took much longer. They rose about 11% on Wednesday to 148, jumping more than 40% after bottoming out on August 3rd. So it was a sharp move, and it pushed the stock back above the IPO price, which was in danger. It was a 135 IPO. And some pressure was put on there after some of the shorts came in, and basically betting that the stock would tank. And I think that was probably the correct call when you were looking at $200 a share. But you have extremely bombastic statements from the founder, Elon Musk, saying that the company's AI revenue will surpass the rest of the company's revenue in September. And this is a point also where more than 911 million shares were released last week, which obviously is going to create a lot more selling pressure, right? And that's about 7% of the company's total outstanding shares. So that's, I think, the real story, because such a small number of shares and supply was restricted. It naturally is going to have all things being equal, positive accretive effect towards share price. And as more of these shares become available for unlock, you're going to see investors choose to exercise and exit the casino. Granted, some of their individual situations are different. Some of these have been holders for quite some time, or they're embedded in different structures and different funds that have their own restrictions and their own limitations of liquidity, and they're going to look to satisfy that. So as we kind of look to see another company that we mentioned, Cognition, on the AI side, they are big into the kind of agentic coding space, and they were behind the coding agent Devin. There's talks that they could be in a new round, as much as $40 billion to value the company. And that's a big jump from the $26 billion that it commanded just in May, when it raised $1 billion. And so these are some figures that are coming out from Bloomberg. The ARR, again, we mentioned that that's kind of a silly statistic. It's reaching 1 billion, and that's roughly double what it was just 3 months ago at 492 million. So now, folks, you're starting to see how this ARR number in business is a little bit confusing, right? Because ARR is supposed to be an annualized number, and now we're talking about doubling the annualized number in just 3 months, right? So first of all, that's not enough time to sort of make a clear, conclusive cut of a financial performance, enough to basically double or almost double a company's valuation from 26 to 40. But this is more about the macro, about how much the kind of agentic coding and AI coding in general is going to expand. We've seen this in our portfolio and in companies like Blitzy and others, where the cost per code dramatically is cut down when you're shifting from good software to replace average coding done by human beings. And that's a really critical piece and distinction. It has to be good software and it has to be average coders, because at the end, when you're using some of these tools, even coders use a ton of tools. So this is nothing new that technology will not totally supplant humans in the loop. Coders use tools all the time to help find mistakes for their debugs, or to even come up with different ideas on how to architect a system. I know about that from my time back in the enterprise technology space and in big data. Working at companies like Oracle, they were factories. So I would be speaking with a customer in the go-to-market team. You'd figure out, oh, they have a very specific need for data. Let's say they want to have an ability to talk to a couple of their systems and we're going to feed them a very specific data pipe. Well, maybe that pipe isn't yet built, but that pipe looks a lot like something we've already built. So instead of building that from scratch, a smart engineering team like some of the ones that we had at Oracle, they will be efficient with how they're able to, copy their work to, let's say 85% completion or 90% completion. That's not done by a human being. That's done by some system. And then they will tweak that kind of 10% on the endpoints to make sure that everything matches up properly. And that was done way before the launch of, some of the more powerful tools like Cognition or some of the others that exist now in the market. So, they are really working with this tedious long tail work and really modernizing this legacy code in where Cognition is spending its time, migrating apps between platforms. And that, I think, is a big area. It's also one, again, that we've invested pretty heavily with companies like Blitzy that will look to revive some of the tech debt that is present in not just technology companies, but technology in general. We've all felt it, right? Working for an organization, a particular process might be super clunky, but we have just grown to accept that's the way that it is because it is the way that it always has been. But with kind of some of these tools, the promise is that it doesn't have to be that way forever. But really, it's because that cost is starting to go down. When you have to prioritize a backlog, the first way to do that is to ascribe a particular revenue projection towards what that change might actually do for a business. And then obviously how much does it cost in terms of the human development hours that are required to get it to change. But if you have a tool now, which is drastically cheaper than, again, average or below average human coding assets, well, then, you have now an opportunity towards really cutting into some of that tech debt and hopefully, modernizing systems and moving away from this legacy track that, oh, this is the way that things have been previously. So they have to be like that for the foreseeable time because, it's just too expensive or there's not enough like customer demand to justify a particular ask. Now, we're not saying that, the fundamental backlog of enterprises is totally going to change forever. I think there will always still be an attention towards, the impact financially to an organization. That's how tech companies have and always will be structured towards the bottom line and not just necessarily consumer experience. I think they go hand in hand. Consumer experience can help the bottom line because it can help customers use your products way better. But in the end, these tools will kind of be complementary in terms of figuring out cheaper ways to just move products and expedite large backlogs of tech for, in this case, in Cognition's case, customers like Mercedes, NASA, and Goldman. So they have kind of a big swath of different industries from auto to financial and even in aerospace. So we'll see again the lion waiting in the grass, which is these larger IPOs. Do they happen in the fall? Are they positive? Are they negative? And how that will affect the ensuing funding cycle of other startups to come. So normally this is the time of the show where we'll pivot and talk about not just a story in words, but a story in a graph, right? If a picture is worth 1,000 words, a graph is worth 1,000,000. But there is one problem. My computer is still in Chapel Hill. It's somewhere in route and progress. I am told I will get it back soon, so I'm not able to do a screen share. For those on YouTube, bear with me. We'll just try to do this the old-fashioned way. I still think it's important and valuable, and we appreciate all the feedback that we get from our users, that you like listening to this stuff. And we always try to give people what they want, as well as kind of highlight what we think is important based on just what we do every single day in the ABCDs. So talking a little bit about this, this latest case for our chart of the week, let's look a little bit at the European savings, right? So kind of, I love these topics of, how does a butterfly's wings flapping in the Pacific lead towards a hurricane in northeastern United States, right? So kind of these butterfly effects. So this chart of the week is brought to you and to us by the IMF. And so kind of the punchline here is that their savings in Europe have no place to go. And so they're basically trying to make a case for unfragmenting finance. And so the argument here is that the financial markets are too shallow and too nationally siloed to fund some of these promising young companies. And so what we're thinking about here is a little bit of what we have seen anecdotally, right? When it comes to funding in startups on the blockchain space, Europe is a clear, distant follower. And I'm being generous, I think the top markets still continue to be US and Asia. It'd be interesting to see, depending on the flavor of the week, the Middle East could actually jump and leapfrog Europe for investment interest. And of course, AI, I think everybody has been interested in general. But if we're looking at this, fragmentation, diving in a little bit deeper, using Mistral's AI SML round, it was the exception that kind of proves the rule that like cross-border investment of that kind is pretty unusual. And so really these good projects, they fail to achieve scale. It's not that, our European friends are any less capable than we are here in the States. It's mostly just that there hasn't been the same fostering to really get some of these projects to scale. And so when we're looking at what the IMF presented, they basically have pinned this at a structural mismatch. Divergent banking regulations, deposit insurance schemes, and insolvency regimes deter cross-border lending. And then the restrictions on pension funds and insurers provide risk capital, keep venture capital small. I'll tell you guys our own personal experience with trying to raise funds out in Europe was much more narrow of a focus and an ability than the US, Asia, or the Middle East. There were many more restrictions towards what allocators would do into venture. Number one, we found that it was either like large generalist funds, as per usual. They will get the majority of the capital. I often said the stat many times, I'll repeat it again, that 50% goes to the 12th largest and 75% goes to the top 20. So really ultra concentrated. And if you look at how some of those large groups invest, they will tend to invest in very similar deals, if not the same exact deal. So you're getting an ultra concentrated exposure into the market, which is great when things do well and less great when things do not do so well. Coupled with the mega rounds that we've seen in things like AI, you are really challenged to find optimal performance multiples. That is the historic good performance where VC will outperform stocks and bonds by a fair margin. So when we kind of look more at the IMF's report, their estimates suggest that even a moderate push to lower things like the cross-border, banking barriers, they would raise the EU GDP by 2% in long term, which is a staggering amount and a staggering projection. I would love to dig into those details to see how real they may actually be. But I think, directionally, it does make some sense. If you lay on VC-friendly legal, tax fixes, plus pension and insurance reform, that can maybe even do a touch better than just 2%. potentially I'm biased here, but I do think that VC can be one of the greatest mechanisms for wealth creation, because in the end, you are investing in innovation in its purest form. And as Buffett has said historically, the best way towards driving wealth is finding and discovering mispriced assets. And there's no greater mispriced asset than something that's starting at the ground with extremely high potential that can actually convert and make use of these, blue sky, blue ocean type of opportunities. So I think that, Europe has been, as we've mentioned, a bit of a laggard in some of the investment and follow-on capital, particular into the VC space. And it has not affected, however, some of the deal flow that we can see from the region, but it does limit some of the larger deals that can go and raise into the later rounds, because they just have been weeded out. Either they were poor performers or they're not getting sponsored locally. And in the end, investors, we all tend to be focused in particular markets, right? We will invest in the areas that we are most comfortable and most familiar with. And there tends to be a home bias on that. At Morgan Creek, we've been fortunate because we have wings all over the world. And that has allowed us to really source things from Asia, things from Latin America, the US, and of course, Middle East and Europe. So otherwise, it could be very difficult to find opportunities that are not just in your backyard. So you could be missing on a whole lot of things. But at the end of the day, it's better to miss on a lot by really focusing in on what you're good at and what you can understand well and find that at the right price than trying to spread yourself too thin, obviously. So we can, really think if you're looking at a potential 2% unlock of GDP, it seems kind of like a no-brainer to open up some of the gaps and reduce some of the challenges into this market. But I think there's a lot more that has to happen. There needs to be a lot more lobbying. There needs to be a lot more also success metrics. So there's some FOMO that gets created, and ultimately just integrating those deeper financial markets that could ultimately create a huge effect and positive impact for Europe. Hopefully my computer returns next week and we can do the visual part of the chart of the week, the million word version of the chart of the week part of our show. And we just want to thank everybody for tuning in week after week. We hope that Mark enjoys a vacation. If you are listening to us on vacation, we thank you for doing that. We hope you have a great weekend or whenever you're listening. Don't forget, if you're not subscribed, please do that. Rate, review, give us 5 stars if you can. And we want to just thank our listeners as always and remind them to stay current. Thank you for joining us this week on Digital Currents. Check out our links to our website and social media in the show's description box. Please make sure to subscribe if you like what you hear. And remember, stay current.
This podcast should not be construed as investment advice nor solicitation for the sale of any security, advisory, or other service. Investment themes and ideas discussed may be owned by funds managed by the host and podcast guests. Any conflicts at the time of production have been mentioned by the host but are subject to change. Listeners should consult their personal financial advisors before making any investment decisions.